Today I wanted to come out to the beach and give you guys one last beach video here in Miami Beach before I leave for my summer road trip, because in about a week from now I will be on the road shooting videos in all different places for you guys wherever I end up until I get to California. So this will be the last beach video that you'll see from me until I'm actually on the West Coast. I'm definitely gonna miss it, that's for sure. You know, being here on the beach and living on the beach, guys, like, it's just the whole reason of living in Florida for me. Like, if it wasn't for this, I wouldn't even want to live here. You know, this is the only reason to be here for me. But I definitely won't miss the heat, and I'm looking forward to a nice, cool summer. Now, today I came across a fascinating real estate story talking about just how grossly overvalued the housing market really is right now. But maybe this time it's different. And that's something I want to know from you guys. Do you think this time it might be different? Because every single time the housing market becomes this overvalued, it's guaranteed that we're going to see a correction or a crash, depending on maybe how overvalued it is and what kind of dynamics we got at play. People are celebrating right now because the stock market has returned to its bull market status, and there's a lot of people that think that it's all uphill from here. I want to bring to your attention a story from Fortune, and they interviewed a guy called Sean Dobson, and he is the founder and CEO of the real estate company Amherst. And basically, they're a real estate hedge fund. You know, they own a ton of different rental properties across the country. They're one of the biggest owners of residential real estate, like BlackRock, like one of those companies, you know. They manage $16.8 billion in capital. They own about 44,000 single family homes that they rent out in 32 different metros across 19 different states throughout the US. So they have a pretty good pulse on what's going on with the market right now. And the good thing is they don't really deal with too many of the crazy markets. They deal with markets that are a little more sane, a little more down to earth, like Atlanta, Charlotte, Dallas. Well, Phoenix is on the list. But they also invest in Tampa as well. So Tampa and Phoenix, those two are kind of dicey, especially right now. And they also have properties in the Midwest, like in Louisville, Kentucky, Cincinnati, Kansas City, Missouri. But they don't invest in places like New York, San Francisco, LA, Miami, these crazy markets where things have gotten blown out of proportion, essentially. So this company, Amherst, they have a bunch of their own proprietary data that they collect based on the properties that they own and invest in, as well as these markets that they're in. And from their determination right now, the US housing market is approximately 40% overvalued. 40%, guys. That is insane. So right away, the first conclusion a lot of people would take away from that is, well, doesn't that mean that we're going to see a 40% drop in home prices then? Well, maybe, but the answer is not really that simple. And that's why I wanted to get into this today, because we're kind of going to get into the weeds of what might cause that to happen and what might not. Because one thing I think that a lot of people think about me is that, oh, I'm all in on the housing crash. Like, you know, I don't see it any other way. I don't look at other people's opinions. I don't care what anyone else has to say on this. But that couldn't be further from the truth, guys. People that know me, you know I'm a pretty open-minded person. And if I see things in data on the horizon that point to, well, maybe we're not going to have a housing crash, I would be talking about it, because one way or the other, it doesn't really matter to me. I just want to give people my ideas and thoughts about it and what I think is going to be the most likely outcome based on what's happening. And so far, all the data that I've seen points to a housing crash, just because things have gotten so overvalued, like we're talking about here. I mean, 40% overvalued is crazy. And to think that that can be sustained long term, I don't think it can be. But we're going to go over some counter arguments in this video of what might make that actually a possibility. Like, how could this potentially be sustained in the long term? The first thing that they look at to determine whether or not the housing market is overpriced or underpriced, overvalued, undervalued, is they look at how much people make, you know, the income, and they look at how much homes cost. They also look at demographics, and they try to put a number on it, like how much overvalued is any given market, or in this case, we're looking at the entire US housing market. And if you check out this chart here from Amherst, you can tell that back during the last housing crash, that home prices were overvalued by roughly 35%. And you can see quickly what happened after that when it all came crashing down and things were worth significantly less just a few years later, to the point where housing was actually undervalued. The funny thing about this chart is that the undervalued part pretty much goes all the way from the last housing crash all the way up until 2020, guys. And we all know what happened in 2020. And a lot of people used to complain how unaffordable housing was before the pandemic, but obviously ever since, it's been an entirely new story. But according to Amherst proprietary data, their chart here says that the housing market was undervalued ever since the last housing crash, pretty much until the pandemic hit, which I find fascinating. Now, one of the big mysteries of the housing market right now is pretty much any economist will tell you that when the Fed raises interest rates as fast and as sharply as they did, then it's pretty much inevitable that it will bring housing prices down. But so far, it hasn't made nearly the impact that many of us thought. Like, if they started hiking rates last year in 2022, you know, by most accounts, many of us would think that home prices would probably already be down by like 10-15% by now, but they're not. Only in some areas they are. So how is that possible? Well, Dobson thinks it's a couple of things. He thinks, first of all, it's because a decline in mortgage rates, which we saw a slight decline in mortgage rates for a little bit there, but honestly, it's already pretty much back at 7% for most people. So I don't really see that being a huge reason why. But one thing that he talked about here that was very interesting is how people are putting billions of dollars at risk right now, betting that mortgage rates or interest rates in general are going to come down. In fact, the consensus is that most people think that it will be down to around 5% within the next couple of years, which could be possible. And the other thing that he says is going on right now is stable income growth. And because we have this strong job market right now, and people have gotten raises, that they've essentially been able to keep up with buying these expensive homes at these interest rates. He says that when you combine that with the stimulus that we got during the pandemic, plus everybody getting raises over the past couple of years, then that has been enough to sustain this housing market so far. In fact, people quitting their jobs is still good for business for them in many cases, because typically when someone leaves a job right now and goes to a new one, they'll get about a 10% raise. So that's not too bad. But what Dobson is saying here, that this all hinges on a couple of things, is we need to see a scenario where incomes stay high, but mortgage rates continue to drop, and that will produce a scenario where we won't have a housing crash. But he also says right in this story that if we have a recession that lowers both incomes and interest rates, that this will not do the trick. Then we're looking at an entirely different scenario where you're likely to see big drops in the housing market. And this is why I keep saying, guys, that that's what I think is going to happen, because all signs point to the fact that we are going to have a very big recession. If you don't think we're in one already, it's going to lead to a lot of job losses. The Fed has said this time and time again, and interest rates have been promised to remain high for quite some time. So this is exactly the type of scenario that is not conducive to keeping home prices high. So it's not like I'm just throwing some hypothesis out there when I think that the housing market's going to take a big hit. It's because of the fundamentals that are at play right now. Because here's the reality. A situation where interest rates start coming down and we don't have a recession and employment remains high and incomes remain high is pretty much a fairy tale, if you ask me. I just don't see a scenario where that could be possible with where things are at right now and what the Fed is promising to do. To me, that just sounds like wishful thinking at the moment. It's always funny when you got people on the beach that are afraid and they think there's sharks out there, but it's actually just torpons. And it's not that hard to tell the difference, because when you see them like this, you know, sharks are a lot larger and swim pretty fast. Now, what could be different this time? Because if this time is different, there has to be some kind of wild card scenario that didn't exist in the past that could potentially keep home prices elevated, right? Assuming, let's forget about for a second this magical scenario where rates come down and unemployment doesn't go up and everybody just lives happily ever after. Putting that aside, what's changed the most since the pandemic? Work from home, right? Remote work has been a huge shift in the way people work the way people commute or don't commute in this case, and where people decide to live. So one thing that Dobson says here is that housing is becoming the beneficiary of all the lost occupancy in the rest of real estate, like office space and places like this, where companies used to have, you know, a lot of office space, and now a lot of companies are letting go of their office space or trimming it down significantly so people can work remotely, things like that. And because people are working remotely, well, they're still here, right? They still have their job, they're still working, they're just not at the office. And since they don't have to be at the office, they're deciding to change where they live. And we've covered many stories about this, on how this hasn't worked out well for everybody. One scenario he gives here is like if you had a couple that lived in a one-bedroom apartment whenever they were both commuting, that might have worked just fine. But now, if they're both working from home, that doesn't work so well anymore. And now they are willing to pay a premium for having extra space and have that garden and be able to have some outdoor space that they didn't have before, which does make sense. So basically what he's saying is the work from home dynamic has changed the demand for houses. And this is one of the reasons why home prices have gotten so high, when you combine that with the fact that people had very low interest rates to take advantage of for a long time. Also, a lot of these remote workers take their big tech salary from the big city that they're in, New York, San Francisco, LA, whatever, and bring it to the small town suburbs where housing is relatively affordable for them and is basically cheap, which also helped people bid up the price of these homes beyond belief, like we saw. The question is this permanent? Is this going to be a permanent trend? Well, we've already seen a bunch of companies change their policy on remote work, and we have no idea how many more companies are going to change their policy with this in the future. That is a big question mark right now, is how many companies are going to reverse their remote work policy on this. But a lot of you guys who do work remotely, every time I make a video about remote work, you write me in the comments and tell me how if I have to get called back into the office, I'm just going to go somewhere else, right? I'm going to find a different job that allows me to work remote, and that's it. That's going to be the end of it. Some of you have even told me how some of these companies that are requiring return to the office are losing a large chunk of their employees to this because they just don't want to. They'd rather quit and work somewhere else, which makes sense. Now here's the kicker. Based on Dobson's current projections through the end of 2025, he's predicting that home prices come down 10% between now and then. If the median home price right now is $400,000, that brings it down to $360,000 by 2025. Now 10% price reduction can be a lot or a little depending on where you live, and obviously 10% decline isn't much compared to the 30 to 40% increase that people saw during this huge run-up. A lot of people would say, well then there's not going to be a housing crash if prices only come down by 10%. But there's some things that can quickly change that practically overnight, and that is that if interest rates remain high for quite some time, then this puts a huge kink in Dobson's prediction of only a 10% drop. And he even says himself, then we could potentially see real estate values drop dramatically more than that if interest rates remain high for the next couple of years. But the flip side of the coin is the potential that housing received a permanent price jump, and wherever it's at right now, even if it comes down by 10%, is pretty much how it's going to be from now on. You're going to have just expensive housing moving forward, and that's it. So what do you think? Do you think that that's what's going to happen right now? Do you think that this could be a permanent jump in home prices due to remote work? Because that seems to be the #1 culprit of what could be driving home prices to stay high indefinitely into the future. Because remote workers tend to have pretty high incomes, and they tend to live in areas where their income goes a lot further than it would if they were living in the city that they used to. If that's the case, if there's enough remote workers getting paid high salaries out there, then yes, do I think it's possible that housing prices could remain high if none of this ever changes? Yes, I do, guys. And I have no shame in admitting that, because this is a new dynamic that really wasn't at play before the pandemic. Sure, there was remote work, but nothing on the scale like we have now. The big question mark is this going to be permanent? How many more companies are going to be looking to take more positions remote right now? One thing that gets mentioned all the time in the comments is when you have a lot of remote positions, people are saying, well, listen, if the job can be done remotely and you don't have to be in the office anymore, then there's a high probability that your job can get shipped off to a low-wage country and be done for a fraction of the cost. And these people just become unemployed, which would definitely change the dynamic quite a bit. Now, I don't know if that's going to happen or not, but it is a possibility. So like I said, what I'm doing here is I'm just looking at the most likely outcome. And to me, the most likely outcome is that interest rates are going to remain high for at least another year, if not longer, before the Fed starts to bring them down. And since the effects that interest rates have on the economy are not felt immediately, the worst is yet to come as far as the effects on unemployment, the effects on the labor market, the effects on the entire economy, because interest rate hikes just started a little over a year ago. So let me know what you guys think is going to happen from this. And while we're talking about remote work, I came across another fascinating story about remote workers that are being told to return to the office right now. A lot of them are saying that they would actually accept a 20% pay cut to continue working from home. And this was a story that was sent to me by one of my followers, DJ. He's always sending me cool stuff, so thanks for this one, DJ. So from this, you can just tell how desperate people are to not come back into the office right now if they're willing to take a 20% pay cut to remain working from home. Now, the caveat to this is the work from home arrangement needs to be permanent for these remote workers to accept a 20% pay cut. So you got a permanent 20% pay cut along with a permanent remote work status, so no chance of being called back into the office. So if you're a remote worker, would you be willing to accept that? In fact, I might put a poll up on the channel and actually get some real opinions on this. And interestingly enough, on the opposite end of the spectrum, some people even said that an increase in pay would convince them to go back to the office. They proposed that if you got a 50% increase in your pay, would you come back to the office for 4 days a week? So pretty much a full work week, and maybe just get one extra day working from home, and that's it. And the majority of people said yes, that they would be willing to do that. So it really looks like what people want, which is not a big surprise, is some kind of life-work balance, guys, or a reward for not having one. Like, if I'm working from the office all the time, I want to be paid handsomely enough for it, where I feel like the trade-off is worth it doing that commute every day, right? Whereas if I don't have to do the commute every day, I'm at home and I can save more money by not going out to lunch and not putting gas in the car every day and this and that, then I'm willing to take a pay cut because my quality of life is better. So let me know what you guys think about that. But here's the interesting thing to me. This is public information. It's not like I came up with this figure that people would be willing to take a 20% pay cut. And now that more and more companies are aware of this, maybe that will even incentivize some companies to offer more remote work positions for less pay. You know, this is their way of saving money, right? This is how they're gonna cut back and pay people less. That's why I think maybe the logical next step after that is like, well, we can pay these guys 20% less, and as soon as we can train the right set of people abroad to do the same job, then we can start paying 80% less. You know what I mean? And then everybody here is fired. So I don't know, guys, it's a complicated subject for sure. But one thing's for sure is regardless of whatever happens here with remote work and real estate prices, in the UK, these guys are looking at a much worse scenario when it comes to home prices. People over there are getting obliterated right now with refinancing because getting a 2-year mortgage in the UK is one of the most common forms of financing your house over there. And pretty much everybody a couple years ago that got a recent loan for their house, they were in the 1% range, guys. Well, guess what? Now, people that were in the 1% range are now in the 5% range for getting a mortgage. And in many cases even closer to 6%. The average rate for a 5-year mortgage in the UK right now is 5.67%. And they're really feeling the credit crunch over there as well, because some of the biggest banks like HSBC over there are pulling a lot of their lending products. In fact, just from May until now, basically in July, there used to be a little over 5,200 mortgage products on the market in the UK. Now there's only 4,600. So a lot of these banks are removing a lot of the different mortgage products available and lending that's available to people. And this is all happening at a time when millions of people in the UK need to refinance their mortgage because it's over, guys. It's just a 2-year mortgage. So basically it needs to be repaid and they need to get a new loan if they still owe money on the house. Their number of inflation over there is apparently a lot worse. They're saying it's 8.7%, and that's their official number. And a lot of people could argue that our number could be pretty close to the same, if not higher, if they calculated inflation the same way they did 30 years ago. So a lot of homeowners in the UK are saying that they're going to have to give up something in terms of their quality of life on things that they spend money on right now in order to make up for these higher mortgage payments. And guess what? That's how a recession starts. And we talked about the recession that's potentially starting over in California, talking about this recession in Europe, talking about this recession in the UK now. To me, guys, also, this is just a matter of time before it spreads to the US, if you don't think we're already in one. Because the reality is our economy is global. Everything is connected today more than ever before. And if all these other areas are suffering, we're going to start suffering by default just because we do business with them. We are connected with them. I think the only reason that things have held up as well as they have here is because, let's face it, we have the world's greatest money printer here in the US. You know, we hold the world reserves currency status when it comes to the US dollar, and that's something that no other nation can claim. So that's a massive advantage for us here in the US. But to me, when you hear stories like this, that a lot of people can end up losing their homes over there or have to give up paying for things because they just don't have the money, it's only going to be a matter of time before that spreads. Just like the pandemic did, it's going to spread everywhere, and it's going to affect everyone across the world. If you guys enjoyed this video, make sure you're subscribed to the channel. And if you don't want to wait for my next video, check out this one on the screen right over here, and I'll see you in the next one.